For the first time in a decade, Indian investors are witnessing a full-blown bear market. The spread of COVID-19 has mauled the stock markets, and this 2020 market crash is a harsh reality check for momentum investors. Let's do a three-point analysis to see how investment patterns will really change post-coronavirus. 1. Quality at any price. Well, over 2018 and 2019, momentum investing gained traction among fund managers and institutional investors as well, as a few large cap stocks were rising like hot air balloons really. Now, despite the heady valuations and meager earnings growth, investors were actually flocking to buy these high quality names to ride the momentum. However, the black swan event of COVID-19 has hit investors who paid little attention to valuation risks. Let's see this with an example first. Now, Bajaj Finance, the leader of the last bull market, has actually given up its 2-year gains in a matter of just 6 weeks. At its peak, the stock was commanding premium valuations of more than 7 times its book value. Stock had also witnessed a parabolic move just before the market crash as well. Now, investors valued this company based on 3 to 4 year forward multiple to really justify the stock prices it was commanding then. With the COVID-19 led stock price crash, investors are still finding it very difficult to justify even the discounted valuations, as the business is staring at a double whammy of lending book contraction and a sharp surge in loan delinquencies as well. 2. Value investing to make a comeback. Well, with earnings growth lagging across India Inc., value investing had not been working for the past 4 to 5 years. However, the style is set to make a comeback after the coronavirus crash. Investors should target the mid to large size businesses with robust fundamentals and clean track record of promoters, but avoid valuing the business on traditional metrics to ascertain the margin of safety. Rather than the earnings, investors should really focus on strength of the balance sheet and also market positioning to gauge the value of the company or the stock. Valuation metrics such as price earnings and dividend yield also should be avoided right now. Fundamentals should be the starting point for you, but investors should also do a little stress case of the business, whether it has the ability to survive if things do get worse before they turn any better. 3. Time to review your investment thesis. Well, investors should also reassess the relevance and also the growth prospects of a business in the post-corona world from here on. The world is expected to transform in multiple ways, as the pandemic is causing serious disruptions to health, wealth, and also life. Going forward, we also expect consumers to turn risk-averse and anticipate them to avoid financing schemes while purchasing small and mid-ticket items as well. Now, in fact, this shift in behavior could also have a detrimental effect on the value chain of the entire sector: financials, consumer durable companies, and the retail stores. While most of the businesses will have been hit hard due to the spread of coronavirus, a select few businesses are also benefiting as well from the current situation. The demand for hand sanitizers, for example, has skyrocketed, and the government of India has asked liquor manufacturers and sugar mills to bridge this shortage of demand, and industry leaders such as United Spirits and also the Radco Khandan Company have started manufacturing the same as well. On a similar note, Mahindra & Mahindra and Maruti Suzuki have started the production of life-saving medical devices such as ventilators to support the medical fraternity as well. Now, the virus could actually turn out to be the tipping point for many industries, especially healthcare, and a few businesses might reinvent and transform themselves with newer products and business lines in the years to come.